Okay, guys, so welcome to this brand new in-between episode with Dr. Wesley Grey. And Wes, we're really happy to have you in the show. I would actually first like to introduce you, and then you really have to tell me why there's a bear sitting just behind you. But for those of you that don't know Wes and his fascination of bears, I'd want to introduce him by saying he earned his MBA and his PhDs from University of Chicago Booth Business School. He is right now an assistant professor at Drexel University. He also has his own asset management company, Alpha Architect. And most importantly, at least for this show, he's also the author of a brand new book called DUI Financial Advisor. But Wes, what is that behind your left shoulder? I've never seen that before.
Sure. So when I bought my house, there was the guy I bought it from was literally a world-class like trophy game hunter, and he had this trophy room. It's about 2,000 square foot with 160 dead animals that he shot over the last 40 years. And he was dying from pancreatic cancer, and he had a few of his trophies that he was going to die, and his wife's like, Ted, can you please get rid of those or figure out something to do? And I was going to buy this guy's place. And he's like, hey, Wes, he's like, tell you what, can I give you an offer that you won't refuse? So we ended up acquiring like a leopard, a Marco Polo sheep, our friend Grizz, the grizzly bear here, and a few others. So if you ever stop by, you could see literally like a world-class like leopard, a bunch of other things. But we keep the bear in the office just because we like to say we kill bear markets. So that's why we keep Grizz, the grizzly bear, there.
That's so awesome. And I mean, Wes, you're probably one of the smartest investors I know, and knowing that you invested in bears and just dead animals in general, that's awesome. I never heard about that before, but I don't know. Perhaps if we start doing it, Wes, it will probably start trending soon, I'm sure.
Yeah. Well, hey, it's a value investment, right? It's you buy it for pennies on the dollars. I couldn't refuse, man. It's genetic disease. I like to buy cheap stuff.
That's amazing. So, Wes, first of all, I really want to say thank you so much for coming on the show. And one thing I do want to say is that we have gotten a lot of feedback from you and a lot of questions from the audience that they actually wanted to ask you. And that's also why we are putting you on this in-between episode. So, but I think I'll just jump right into it and ask the first question, because one of the things that you were talking about is that you can actually be your own financial advisor. And if anything, you might be better off being your own financial advisor. Actually, in your book, you state that experts generally don't do very well. There's one statistic in there where you're saying that only 6% of the time experts actually do better than simple models, and 46% of the time simple models would do better than experts. Could you elaborate on those statements?
Sure. So on the first comment there with respect to advisors, so the book is called DIY Financial Advisor, and the idea is that if you actually have the discipline to follow a simple, basic, reasonable model, it gives you the opportunity to save that 1%. Now, the problem is you lose those psychology coach benefits. So if you save the 1%, but you don't have the discipline to actually carry through on your investment program, clearly that cost-benefit trade-off is not a good one. Do have that discipline, you can stick with a program. We think it probably does make sense to at least potentially try DIY. Now, with respect to experts, as you mentioned in the book, I just highlight and cite a lot of papers and research that's out there. There's been this remarkable finding in the psychology research over the past 60, 70 years where they literally will go out there and test a simple algorithm's prediction or forecastability relative to the human experts, and incredibly the simple models tend to meet or beat the performance of these human experts. And a natural question is, how in the heck is that possible, right? And the arguments, I kind of break it down, are that humans have access to qualitative information, humans have access to just in general more information, and then humans also have access to like this intuition and experience. And the underlying assumption behind those three elements there is that by having access to those three elements, it somehow actually enhances a human's forecast ability. Empirically, we know that's not true, so that must mean that the underlying assumption that those three pieces of data actually add value also can't be true. And then you got to ask, well, why? How is it the case that having more information, qualitative information, and intuition can't add value? Well, it turns out that there's a whole bunch more studies that highlight that humans are really, really poor at processing information. And the first finding is that the more information we get, it doesn't actually improve forecast accuracy, it increases confidence. So if you have a situation where after the first 3 or 4 data points, your forecasting ability is pretty much maximized, and then you go out and read 10Ks for 10 years and, optimize on 10,000 additional data points, you would think it's going to enhance your forecasting ability, but it systematically doesn't. But what it does systematically enhance is your overconfidence in your forecast, which always leads to problems. So problem one is more data does not equal better forecasting. It equals more confidence. The problem two, I just got my notes here, is that another thing that psychologists find is that the same data viewed by a human expert can when they view that data, they can come to different conclusions depending on just their environment. So for example, if you show up with coffee, you might, predict X reading the data. Next day you show up, you don't have coffee, you'll predict Y. So it's very unstable, basically. And all these bias issues cause problems with humans.
Yeah, because Wes, what I found in your book was it was not just stock investing we were talking about. It was basically in everything. It was also in like academic performance, or in I think it was also in used in military, that if you have someone in the military saying we're going to succeed with this strategy, or this person will be successful, we can actually just model, have simple models that can do it better. So it's not just stock investing. Is that correct?
That's right, and that's what makes it so fascinating. It's pervasive through all prediction across all fields. So stock investing, medicine, military performance, job performance, you pretty much name it, people have studied it, and it's just this overall effect that human experts, because they're so flawed with more information and overconfidence problems, they tend to make poorer decisions than just a simple algorithm that is able to kind of figure out the actual signal and separate that from the noise.
Yeah, so one of the informations that we keep getting at least 4 times a year, that's GDP. Like if I'm a stock investor, I would typically pay very close attention to the real GDP growth, because that tells me about something about how well the economy is doing. If that's doing well, businesses are making more money, people have more money, and they can spend more money, which will typically mean, at least in my intuition, that stock price would soar. But you actually also look at that not only in the U.S. but also internationally. So what did you find to be the relationship between real GDP growth and stock prices?
So it's not what I found. It's a guy named Jay Ritter, who's very famous in IPO literature, but he has this paper where he says, you know what, I'm getting tired of listening to people always talk about GDP and all these macro statistics as if it matters for predicting future returns. And he has this paper that basically highlights that there's literally zero relationship between a country's GDP growth and their stock performance. And again, that's not necessarily intuitive, so you got to dig in. And what really drives stock performance is something that value investors know and love: price you pay, right? If you pay a low price for something, you tend to get high returns. If you pay a high price for something, you tend to get low returns. It's just almost the math of investing. And another thing that I like to always highlight is just look at what Warren Buffett says, right? Essentially, a lot of his anecdotes and stories boil down to, businesses need to create value, but they also need to be able to capture value. So for example, automobile industry or the airline industry, these are all businesses with insane quote-unquote real growth, but insanely terrible businesses because they create a lot of value, they don't capture any value. And a lot of times people get confused with the difference between growth and a good business.
Okay, really, really nice, real nice to know, and I think that's something that a lot of investors can really learn from, and probably also the financial press, because it is all over the place every time there are new GDP numbers, and I don't know if that actually explains the stock returns, at least in the short run, but you've proven that, or you're referring to someone that's proven that it really doesn't matter in the long run. Now, I would like to talk to you about modern portfolio theory. And I think that's extremely interesting to discuss with you, also because you are right now an assistant professor. So am I here in Denmark, and I'm pretty sure that we were both taught that markets are efficient, right? And we've been taught how to look at portfolio. Like there's some very strict formulas in terms of how to look at portfolio. So could you first tell me what does the classic portfolio theory tell us, and what have you found?
Sure. So real high level, the kind of the main magic secret sauce of modern portfolio theory is this idea that you can somehow pull together things that have a lot of volatility, but if that volatility is unrelated to one another, that volatility essentially vanishes and you can get closer to just almost guaranteeing an expected return, which is not intuitive. You can pull a bunch of volatile stuff and actually get something that earns the same return but that's much smoother. With this whole idea of diversification. So high level, that's a good concept. It's just mathematics, all great. Now, modern portfolio theory basically says, listen, taking what we know about statistics, we want to identify portfolios that essentially maximize our Sharpe ratio, our risk-adjusted return. So modern portfolio theory, what it's going to do is it's going to say, okay, we're going to have two primary inputs. We're going to input an expected return matrix, or we're going to have for all our asset classes enter in like what we expect their returns to be, and then we're going to input into the algorithm what they call a covariance matrix, which is basically just a matrix of how all these different asset classes are related to one another. We're going to pump it through a mean variance algorithm, and we're going to basically maximize the Sharpe rate, find the weights that we would invest in these asset classes such that we maximize this Sharpe ratio. And it's what they call the Tangency Portfolio. It's kind of the portfolio that everyone's supposed to own. And that's what modern portfolio theory basically suggests. And that's what everyone won the Nobel Prizes for.
Yeah, and for some weird reason, you can almost spend a semester talking about that. I don't know if that happens, but you actually can.
Exactly. It's
and you actually capture it in like 3 minutes, right?
That's, exactly. Well, it's confusing when you get in the details of it. And like you, I teach a class on that as well, just because even though, well, we'll talk about here in a second, it's unclear that it actually does anything. It's a great thing to teach because it's complex. There's a lot of homework assignments you can churn out there. Everyone in the world kind of, that's their frame of reference when we talk about portfolios. So that's why you and I teach it, even though arguably it's, you know, you could say it's probably BS at some level, at least empirically.
Yeah, well, it is actually hard to find a textbook that is not saying it. I don't know if that's really the main problem. Because I think it was Charlie Munger has this quote saying, what do they actually teach at business schools after they're telling you that everything is efficient? And yeah, it's kind of funny because there's a lot to tell, but basically you summed everything up like at least for 3 or 4 classes, like really, really fast. But I think it basically boils down to it's all fits very nicely into an equation, and we really like that. We like when we can put things into equation and, you know, prove it and then just move on to something else.
Sure. Yeah, exactly. If it's one of the things a lot of people don't realize, like about academics specifically, is there's way more clout for those who can find what they call a closed form solution. So in math, like if you can find like a nice equation like E equals MC squared, that's going to get a lot more kind of clout and credibility in the community than saying, hey, I got this rough approximation answer, because it's not elegant, it's not sexy. So, and obviously the professors in the research kind of define the agenda of what gets taught to students. So if they think it's cool, guess what the students are going to get taught? What the professors think is cool, not necessarily what works per se. Because we'd all much rather have Warren Buffett or Charlie Munger as our professors, not some egghead.
Yeah, and the funny thing is that even though it's can be improved in so many ways that the markets are not efficient, it's just so much harder to teach. I mean, you can't do that in a semester. You can do that in like 50 years perhaps, because it's so much more complex if you can't put anything into an equation. But actually, going back to the questions, one of the things that I found really interesting was that you actually test an equal-weighted portfolio. And compare that to the model theory. So what's the difference? What's the outcome?
Sure. So in general, this was inspired by Victor de Miguel and some of his colleagues. He's actually not a finance professor. He's an operational research professor, where they went out there and said, wow, all these fancy finance guys, they make all this money, and they've been coming out with these incredibly sophisticated models on how to allocate assets. Let's just go test that against like 1 over n, or equal weighting, right? So if we have 10 assets, we just do 10% in each, as opposed to some whiz-bang like math equation. And they have this paper that kind of turns the finance literature on its head, and it says, hey, all your guys' fancy models, when we actually test them out of sample or in like real world data after we came up with the systems, they don't even beat the 1 over n, like the simple equal weight. And then of course we want to take that in, reverse engineer it, and we highlight that in the book, where we show this example where we say, let's just have a basic portfolio of stocks, bonds, and some alternative allocation, like a long-short value play. And sure enough, we say, okay, we're going to do the fancy, modern portfolio theory version, and then we're just going to compare that against 1/3, 1/3, 1/3. And sure enough, the 1 over n equal weight outperforms and is way more simple than the fancy, crazy modern portfolio theory stuff.
Yeah, and that I was I don't know if I was surprised, but I'm definitely surprised that no one has really picked it up. I mean, I think it's very beautiful what you outline in your book, because it's so simple. Like it's just an equal weight. You're not using fancy formulas or tricky terminology. It's just like what happens if we have an equal weight, and we actually get a better return.
Yeah, I mean, our core beliefs are we want to be systematic investors to avoid all those behavioral problems, and we want to be evidence-based investors, not story-based investors. And what you'll find is in financial markets, a lot of times, not all the time, simple, basic rules are actually easier and more effective. And so the question is, well, why wouldn't everyone just do that? And the problem is, of course, there's incentives in financial marketplace to make things more complicated than they need to be, because that's how you justify, fees. It'd be really tough for an advisor to show up and say, hey, we're going to take these 10 assets and just equal weight them because that's more effective, more robust going forward, and we're going to charge you 1% to do that. And even though they're probably worth that 1% because they're going to be a good psychology coach and they're doing the right thing, everyone's going to be like, well, why would I pay you when my banker over here has this like team of 50 PhDs that figured out this really cool model? They're totally worth 1%. And so there's bad incentives in the marketplace to bring evidence-based solutions that are simple to clients, because it's bad business, basically.
Yeah, and you're definitely right, because asset management, to a large extent, that's really just marketing. And I mean,
definitely.
And I don't want to dilute anything you're doing, Wes, not at all. But saying to people, guys, I have a really simple equation, and that's probably going to outperform the stock market by 2, 3, 4%, because I have done so for more than a century. It's just not that sexy. And then you might have someone saying, we have Wes and his 49 other PhD buddies. Yeah. They can just, find all the right stocks because they're really good at math. And when math is not enough, they just know things. They just have a lot of great knowledge that no one else has in the world. And it's just much easier to give someone 1% or 2% doing that than just an equation. Because why would I give you like 2% and 20% of the profit if you just have an equation? It's probably not going to change.
Yeah, no, exactly. Yeah, financial services is definitely, as we're learning kind of slowly and steadily here, a marketing game, like 100%. Most people sell stories, not evidence. Um, and as you mentioned, like we go out to the marketplace and say, hey, one of our core beliefs is evidence-based investing, not stories. And that sometimes the evidence does conclude that more complication is better, but that's frankly rare. And we just tell people like, hey, here's kind of the answer. There's a lot of tricks to following simple models. Like it sounds easy, but in reality, sticking to a simple model is actually really incredibly difficult because simple models that work don't work all the time. And a lot of times, a lot of people need like a psychology coach to say, listen, remember that evidence we showed you? Remember this whole program we all kind of signed off on? You're about to jump off the ledge, and I'm here to tell you that's a bad idea. And just because sometimes people need that psychology coach there to help them, or they just screw the whole thing up effectively.
Yeah, and I love you're saying that. It seems like for the investor, it's really a psychology play, and for the asset management company, it's really a marketing play.
Yeah,
Um, yeah, I guess that's just the name of the game. The next question
got it.
I prepared is actually to talk to you about Sharpe's ratio, because you actually just briefly introduced that. Sharpe's ratio is one of the most important things to know how to calculate in academia. It's actually very, very simple to calculate.
Yep.
But the intuition is very interesting. So perhaps you could tell us what is Sharpe's ratio and
Mhm.
which indicator do you suggest is the best one to capture the performance of a portfolio?
Sure. So Sharpe ratio is essentially you're going to take your expected return on a given asset class, and then you're going to take off like what they call the risk-free rate, typically like the 90-day T-bill, and that's going to kind of represent your excess expected return for kind of the benefit of owning this asset. And then that's on the numerator, and then the denominator is just your volatility, your standard deviation. So how volatile you are, and the concept is that we have a benefit, which is excess expected return, over a so-called cost, which is volatility, and all else equal, if we're operating in a vacuum here, we want to own assets that have a lot of excess return, but not that much volatility. So that's kind of a high-level concept, and we do a ton of performance analytics and review a bunch of strategies. We work on behalf of a huge family office, and I wouldn't say there's any one measure that does everything. The best way of doing performance assessment is looking at the picture from all different angles. And the Sharpe ratio is actually a great place to start because we can talk through the issues with the Sharpe ratio. And most of them have to do with that denominator, which is just a simple volatility measure. The first one is that a volatility measure is going to penalize equally upside volatility as well as downside volatility. So if I was an investor that I kind of don't do anything and then every month I shoot up 10%, that's going to actually have a lot of volatility, but clearly, do we want to penalize that person? No, I would give that person, if they could do that, all my money and leverage it, right? Because I mean, that's like awesome volatility. But
Yeah.
yet, volatility metric is going to penalize that. So one solution there is you could use what they call downside deviation, where we only look at the volatility of episodes where it was actually on the downside, because we just care about that bad volatility, not necessarily good volatility. And you can use like Sortino ratios to capture that. So you could be like excess return over downside deviation, not like typical standard deviation. Another area where volatility is flawed is that standard deviation or volatility doesn't tell you a lot about the tails, or what Munger and Buffett like to call like the permanent loss of capital events. Because really in the end, we as investors shouldn't care about day-to-day, month-to-month volatility. What we really care about is real volatility that blows us out so much we can never recover from it, i.e. a 50% drawdown or an 80% drawdown. And so to identify that sort of risk, volatility isn't going to exactly capture it. We need to look at things like worst drawdowns, or another measure we always look at is the worst 30 drawdowns over like a time series, because we want to understand what is the risk in the tails and basically on the downside, and don't include kind of upside volatility. So there's a bunch of different ways we can be smarter about analyzing volatility, which is embedded in the Sharpe ratio.
Yeah, so this question is actually very much related to this, because this is beta. And when we talk about risk, we very often hear that people will say, so what's the beta of that stock or for that portfolio? So do you think that's another volatility measure, but do you think that's a good measure? Perhaps you can first introduce to the audience what beta is.
Sure. So formally what beta is you run a regression of your returns against, say, the S&P 500 returns. If you get fancy, you could do it in excess format. But just for intuition here, you're going to run just a linear regression between, say, Stig's mutual fund and the S&P 500. And that beta measure is just going to show you how your Stig's mutual fund is linearly related to the market. So if you have a beta of 1, that would imply that if the market goes up 1%, Stig's mutual fund tends to go up 1%. If the market goes down 1%, your mutual fund goes down 1%. Now, beta is really nice because it helps us characterize in general how Stig's mutual fund would sit in our portfolio. The problem with beta, and the way we look at it, is beta is an average, right? And the problem with averages is if my head is in the oven and my feet are in the freezer, on average I'm 72 degrees, but I'm also dead, right? Because I'm just fried. Beta has the same problem, where really what we want are assets that have high beta when the market is doing well, because if the market's going up, I want high beta. And then similarly, when the market's blowing up, I don't want high beta, because I don't want, when the market goes down 5%, I don't want to go down 5%. So even though you may have a beta of 1, it may not tell you much of anything, because ideally we'd rather have is a situation where we have, on the upside we have a beta of 2, on the downside we have a beta of 5, on average a beta of 1, as opposed to on the downside we have a beta of 2, on the upside we have a beta of 0.5, average 1. So I think beta is fine. And the problem is you got to get nuanced about understanding what it's really telling you, and that just goes back to kind of the devil's in the details of beta, basically.
Yes, because Wes, how do you in general think about volatility? Because you will also have investors out there who will be saying, I love volatility. Volatility makes it possible for me to buy really cheap and sell really expensive. So if anything, if you want to look at volatility, I want a high volatility. What do you think about that argument?
Yeah, no, I like that argument. I think Preston read that piece I put out there on sustainable active investing framework, and essentially that's, if you want to be active and have any sort of reasoned way of beating the market over the long haul, you need to, one, find situations obviously where psychology's created some dislocation from fundamentals, and then two, it needs to be hard to make that investment. And volatility, that day-to-day, month-to-month kind of bouncing around, for most human beings is gut-wrenching. But from an investment standpoint, we should love it, because that, as you mentioned, gives us opportunity to get in cheap and sell expensive, as long as we're focused on permanent loss of capital volatility, i.e. huge, losses, which really matters. Short-term vol is actually awesome because it scares so many people off, and obviously value investing is kind of the classic example where everyone knows value investing works, but everyone also knows it's painful as hell in the short run to get there. And that's great though, because we know it works, but we also know a lot of people will never do it, which is why, those sort of opportunities are going to always probably exist.
Yep. And Wes, I also kind of think it's really a social thing. I don't know about you, but whenever I tell people that I'm in stocks and I do what I do, they always say, so what should I invest in, or what is the next Microsoft?
Yeah.
And if you're saying, I use an equation and I buy really, really boring stocks, and the more boring the industry, the better.
Mm-hmm.
It's just not fun. It's not fun to discuss. It's much more fun if you're saying, I have something in nano, biotech, something, it
Yeah.
makes no money whatsoever, but I'm sure it will revolutionize the world. Like growth stocks, that's much more interesting to talk about.
Yeah, so it actually goes back to that original chat we had about GDP growth and just behavioral in general. People love to think about stories and cool stuff, but they never actually consider what is the signal and what is the noise. The evidence is very clear that growth in itself is a whole bunch of noise, but doesn't have much signal about telling us about the future. In fact, it's a negative signal because it tends to be related to high valuation, which we know is a signal that is actually robust and tells us about the future. So anytime you're getting excited, anytime you're paying a lot for something, on average, you will lose. You are going to get low expected returns. It's almost baked in the cake, but you get the benefit of being cool at a cocktail party. You know, you're gonna track the indexes much cleaner, and in many respects, that actually is a real tangible benefit to folks. But the payment for that benefit is lower expected returns. We're value guys. You know, they look like idiots at the cocktail party. They underperform the market sometimes, and that's costly, but their benefit is higher expected returns over the long haul. So, you know, pick your poison, I guess.
Yeah, I think you're right, and it's basically this whole story versus evidence problem, because in stock investing, you can always come up with a plausible story of why you didn't perform well last year. I mean, everyone can do that, and it's so hard to come up with like a finite number saying, so this is why I didn't do as good as Wes.
Yeah.
Like, oh, I was just so unlucky with that stock pick, or whatever
Yeah.
you might come up to think with. So yeah, I definitely agree with you.
Yeah.
But I really wanted to keep talking about asset allocation, and this question about what is the optimal asset allocation is like probably one of the most asked, and probably also one of the most useless questions to ask, because it's simply too complex and it's very, very individual.
Yeah.
But I think I'll try to test you out anyway, Wes, even though I
Sure.
just said it's a horrible question.
Yeah.
Because, you know, asset allocation is not just by saying 60% stocks, 4% bonds. It's much more complicated than that. So which factors would you include when if you have to make a profile of me and you have to advise me about the most optimal portfolio? What should I consider?
Yeah, so we have a framework that we outline in the book. It's called the FACTS framework. So before you consider any sort of allocation, any sort of investment, we want to think about the facts. And the facts are, it's just an acronym. It's F is for fees, all else equal, lower, better. A is access or liquidity, so more liquidity, better. C is complexity. In general, simple, better, because we're able to understand it, we're able to communicate it. T is taxes. More tax efficiency, good. Less tax efficiency, bad. And then the S is search or due diligence costs. So the more we got to go talk to these hedge fund guys or private equity guys, you know, every year we got to go due diligence them. That's real cost. The more we can eliminate them or replicate them with a computer, it's going to be better. So anything you do, always consider the facts. Now, when it comes to your personal individual portfolio, once we consider the facts on all our investments, I think some of the principles are, one, keep it simple as much as you can. So 1/n allocations are preferable to modern portfolio theory allocations. And then two, build a system that you can actually stick to. Because a lot of times we show people what the evidence shows is the best way of going about it, like if you had to be a betting man. But then you ask them, could you actually do this? Like a classic example is like trend following rules, right? If like S&P is above the 250-day, you're in. Otherwise, you're in T-bills. And even though you can show so much evidence, it cuts drawdowns in half, et cetera, you ask someone, could you do that? And many people, they may say they can, but you know they can't. So clearly that is a good system, but if you can't follow it and stick to it, it's a terrible system. So it's this, when it comes to individual asset allocation, it's really all about understanding the client and what can they realistically do and can't do, and then infuse that with as much evidence as possible, or with our mission, empower investors through education, get them to a high level of decision making, and then try to get them into the best solution in expectation.
So one of the questions that I really like, and this is actually not something you prepared for. It's just an email
Sure.
I got yesterday. That was from one of the users at the forum,
Mm-hmm.
and what he was saying is that how does Wes look at the current market condition? Are we looking to go more into cash and sell out our stocks, or is that also breaking the rules?
Yeah, so I mean, I'll just tell you what we do. So again, we're big fans of trend following and momentum when it comes to market timing, if you want to go down that route. For some people, if you got 30, 40 years of compounding ahead of you, and you can take a 50% drawdown, and you don't want to deal with the complexity of, managing the taxes and going in and out and all these other things, buy and hold's great. However, for a lot of our clients and a lot of people out there, they're 60 or 70, they got a few $1,000,000, and they got to live off this kitty. And you can't take a 50% drawdown, so we need to find ways that risk manage that portfolio. And we personally have found that trend following, or basically when an asset class is above some long-term trend, stick with it, otherwise go to cash or bonds, is very effective. And we do that across a global diversified portfolio of everything, because you want to gain the benefits of diversification. And right now, we're on most of those portfolios, it's 60, 70% in 90-day T-bills, because obviously from August, there was huge blow-ups and everything. A lot of markets are off trend. And in general, when markets get off trend, it's just a bad bet in expectation. You want to wait till they get back on trend before you redeploy capital.
I'm actually curious about the ETFs that you are mentioning. What are you doing about that right now? Are you looking to go more into cash, or is it like SEC requirement that you are fully invested, or how does it work?
So yeah, in those products for transparency and for investor benefit, we're try to be 100% allocated to our best of breed value, or in the future our best of breed momentum exposures, and then we leave it to the investor to choose how they want to take that pill. And as I mentioned, some people, if I got 30, 40 years of compounding ahead of me, you just buy and hold and compound tax deferred forever. For other people, let's say you need to preserve this kitty, even though our value ETFs are interesting and we obviously think they're pretty decent, they have a lot of market risk in them. And if the market that goes down 50%, guess what? Our ETFs are going to go down a lot too. So you might want to deploy risk management, but we don't do that inside of the structure. We just keep it clean as a pure play vehicle, and then the user can use that tool, as they see fit, basically.
Okay, very good point. I don't know if you actually have an opinion on this, or if you can have an opinion on this, because as said before, you are SEC regulated, but how do you look at the current market conditions? I mean, do you think that the market is overvalued? What would you suggest your clients to do?
Yeah, so I definitely think that every asset in the entire world in general is relatively expensive to historical standards. So then the next question is, we got to always think about, what is the signal, what is the noise? And we've asked the question internally, can valuations actually tell us anything about tactically allocating in the short run? Our research suggests that it's foolhardy. It's better to just be buy and hold, because to short run tactically allocate between asset classes based on valuation, we just can't find any robust evidence that it works. We all know it works over long haul. All these asset classes are going to have low expected returns over the next 10, 20 years. One answer is, well, just sit on cash for 10 years and wait for a market blow up, but that's I don't know if that's a reasonable solution. The other answer is, can we kind of tilt away from stocks and move into bonds or whatever? That doesn't seem to be very effective. So again, is set not to be a broken record, but the only thing we've found that seems to be effective at tactically allocating between asset classes and timing is momentum and kind of trend following rules. So that's what we do. I mean, that's what the evidence says, so that's what we do, even though we believe that all asset classes as a whole are obviously like relatively expensive and are going to have over the long haul, on average, lower expected returns than they've had in the past.
Okay. And then you said this about momentum, and you're saying this is one way to manage your portfolio. Well, it's always a method to manage your portfolio, but that might be even more relevant if you're talking about overvalued market that might decline. How does that work in practice?
Yes, so in practice, I mean, we basically focus on two core trading rules, and they're really simple because we do simple things that are evidence-based. One is long-term trend. So you look at an asset class, compare it relative, say it's 12-month moving average. If it's above that moving average, long and strong. If it's below, go to bonds or go to cash. And then the second rule is what they call time series momentum, which is just a fancy word for saying you look at an asset class, look at its 12-month returns, compare that relative to some basic benchmark like, you know, risk-free rate over the last 12 months. If it's been positive, has positive kind of momentum over the last 12 months, you're in. If otherwise, you're out. And just those two simple rules where you always want to be invested in market risk when market risk is trending and the trend is strong. Just follow the model is what I tell people. Like, it doesn't work all the time, but if you want to preserve capital and not engage in 50% blow-ups when, you know, markets are toppy like they are now, and, you know, if enough bad psychology gets brewing, it'll all blow up. You know, trend following that's just the only thing we found that we think is robust and works over the long haul if you want to go down the market timing route.
Yeah, I think it's really interesting, and I think at some later point in time we should do a podcast about that. Partly because I actually know, even though we didn't plan this, that you are looking to do an ETF in momentum stocks, but also because I just finished James O'Shaughnessy's 700-page book about what works on Wall Street, which is there's a very, very similar thoughts of what you're saying right now. So I'm definitely pumped for doing a future episode on that with you, Wes.
Sure, and I can have Jack talk a lot about it. He's our resident momentum guy. But I just encourage all your audience, just Google a paper called Time Series Momentum by Toby Moskowitz and some others, and they just highlight that it works across every asset, across the history of the world. It doesn't work all the time, but it's just a very robust thing, and I know that's heresy for an audience of value-minded folks, and I'm obviously a value-minded guy. I got a liquidation sell bear standing behind me, and I'm just a natural kind of cheap ass, always focusing on good value, but I also like evidence and making money or trying to, and at some point you just got to believe in the evidence, and you have to kind of bite the momentum pill and just realize that, you know, not everything in the world is value only. There's other ideas out there.
Well, Wes, that's a great suggestion, and I want to spare the audience for Googling. I'll just find it and I'll put it in the show notes for this
There you go.
in between episode. But Wes, the final question: where can people find out more about you, and where can they find your book?
The best thing is just go to alphaarchitect.com, and if you go on Amazon, just type in DIY Financial Advisor. The book on Amazon, it's under $20. We're actually selling it at cost for $14.99. If you have Amazon Prime, you know, you can just buy it that way, or just, you know, under the main price, you'll see our cheap price. If you're a value investor like we are, you can buy it there. We've got some inventory that we're just getting rid of that the publisher gave us. So yeah, so it's less than $20, just DIY Financial Advisor. It's on Amazon, or you can get it off our website there.
Fantastic, Wes, and I'm sure that not only I but also my audience would love to get you back on, both to talk to you about momentum stocks and grizzly bears, but in general just to talk about value investing. This has been so much fun, Wes, so thank you so much again for coming on the show.
Sure, Stig. Appreciate it. And I'll leave you guys with a quote that I heard from a guy that I think is really good advice. This guy, Van Hoisington, he manages billions of dollars down there in Austin, Texas. And I saw him at a grants conference 3 or 4 years ago. And he stood up there, and this guy is a really famous guy. And he says, he's like, listen, I don't do anything, and I don't know anything. And that quote right there is emblematic, in my opinion, of the best investors in the world. They don't do anything, and they don't know anything. So sit and chew on that. And even though that's the most counterintuitive quote I can give you, that tends to be the philosophy and epitomizes a lot of the best investors out there. They don't do anything, and they don't know anything. Or at least they're willing to say that.
That's amazing, Wes. Let's that be the final verse for this interview.